Hello traders, welcome to a new video on Bitmex up and down contracts. So what we're going to be looking at today is how we can use these contracts not to trade, but to use them to analyze Bitcoin and to give us another edge in sentiment and a look at what retail traders are doing. So this was Patreon suggested, did not expect that to happen. I thought that one of these two would be more interesting, but I guess full steam ahead on Bitmex Upside, downside contracts. So what is a Bitmex Upside contract? Another way to think about it is a call option. And you can go to Investopedia and look up what a call option is if you would like. It's the right to buy a stock or an instrument, or not like this kind of instrument or this instrument, but like a financial instrument. You could have options on S&P, on Bitcoin, on gold. You could have options on a lot of things. And what Bitmex offers is an upside contract that they don't call an option, but it basically just is an option with strike prices and the same kind of dynamics. It's called the XBT 7D_U105. And you can find this on TradingView if you type that in there. And what you're going to see on TradingView is not the strike prices of the option, but it's actually the prices that traders paid to buy this option. And it's titled this because it expires every 7 days. It's XBT. Upside, 105%. And we're going to talk about like where that 105% came from. So what this allows you to do is to buy Bitcoin with theoretically unlimited upside and a fixed downside. You can only lose so much with this one. There's no liquidation, there's no margin call, and there are no fees, because there's no leverage. And the only cost that you pay is the contract price that you can find on the order book. It sounds good, right? Never buy these contracts, like ever. The upside and the downside contracts, I'm going to go into these. We're just using these for sentiment. We're just using these to give us a look at what other traders are doing. I would highly not recommend buying these. Yeah. You're set up to fail, and we're going to look at the statistics and the probabilities of these even becoming profitable a bit later. All right, so back into talking about the contract. So the contract size is 1/10 of an XBT of a Bitcoin, and it has a strike price. And this is probably one of the most important components of how this works. What is a strike price? Well, this is the price where your option becomes in the money or out of the money. So if we have a strike price at $37.50 and we buy an upside contract, we need price to settle to expire above $37.50 for us to make a profit. If it expires below, we lose that contract. So, rip. And the way that the strike price is calculated is shown here, if you want to know. And settlement is when it expires. That's going to be every 7 days at Friday, 7 a.m. Eastern time. Yes, you can trade before settlement, but if you hold until settlement, the option will be in the money or it will be out of the money. And let's go into the scenarios of holding an upside contract. So first scenario is just settlement price is below your strike price. You lose all that you have placed on that contract. Let's say you buy an upside and the strike price is $37.50. So we need price to go above $37.50. Unfortunately, price at 7 a.m. Eastern time, price is at $3,700. You lose. You lose that contract. Let's say settlement price is above the strike price. Great. Not exactly. It's not a guaranteed thing for you to even to profit, even if price goes above the strike price. So let's say in this example here, this is how we can calculate it actually. Imagine your strike price is $37.50. And your average entry, so the cost that you paid to receive this option was 0.002 XBT, and your contract size 0.1 XBT. Your break-even price is 38.26.5. What this means is that price would not have to go above 37.50 for you to be profitable. Price would have to go above 38.26.5 for you to be profitable. So yeah, good luck with that. And this is just Bitmex showing how exactly that works. So imagine that you have a strike price at 11K and you pay 0.03 for the right to buy that contract. You would need you would need price to go above $15,000 for you to be profitable. So $4,000 above your strike price that would already put you in the money. You would need, because you paid that much for the contract, you would need price to go above 15K for you to make any money on the break even. So the odds are low. And then here is a different kind of example that you can pause the video and look at if you want to know more about it. All right, let's go to downside contracts. And this is basically a put option. It's Bitcoin 7-day, downside 95%. It's the same thing really as an upside, except for two differences. One, the 95% instead of the 105%. So you can think about the upside and the downside contracts as a bet on volatility. So if you were to, if price settles at 10K, the upside contract would be set at 10,500 for a strike price. The downside contract would have a strike price of 9,500. So if you were to buy a downside contract, you would need price to go below 9,500 and then some, and then lower than that for you to break even. And if you bought an upside contract, you'd need price to go above 10.5K and then some for you to break even on that even. So that's where the 95% and the 105% comes into play. The other difference is the KO barrier. This is forced expiration, early expiration, that protects the opposite party. So if you were to buy a downside contract, and you were right, you bought a 9K strike price, and good, price went down to 4,500. Bitmex will not let you just keep making profit. They will say, all right, that's enough. You've made enough money on your downside contract. This is to protect anyone who short sold or sold to you the downside contract. And again, if you short sell a downside contract, you're betting on the market going above the strike price, of course. Because that would make it expire in the money. And speaking of, Bitmex only allows designated market makers to short sell an upside or a downside contract, meaning that market makers are going to be betting on low volatility, and that you, us, anyone who can trade on Bitmex is betting on elevated, on very high volatility, because you need price to go 5% above or 5% below the price, the current price at 7 a.m. Every Friday. So, not a good chance for you. So this is just a way to protect those market makers. If Bitcoin just shot down, you would be forced to exit at a really nice profit, so that they could actually save their shirt. And there's break-even price for the downside as well, which is here. Again, same scenarios here. If settlement price was above your strike price, you lose. Settlement price is below, you might profit or lose. Apologies here, because this is actually incorrect right here. This should be 1 plus. This should not be 1 minus. Your break-even price would not be 3571.5 above the strike price. It would be actually 71.5 below 3,500. So the actual break-even price would be 3428.5, meaning in this example here, with a strike price of 3,500, if you pay 0.002 for that contract, you would need price to go below 3428.5 for you to break even. Not above there, but you need it below the other one. So, and this is what the order book looks like if you wanted to buy a downside or an upside contract. So for downsides, you could buy at these prices here. And each number is 0.1 XBT, as you can see. So this would be 1.8 Bitcoin, this is 4.8 Bitcoin, and so on. Don't buy these. I mean, only when there's no fees, when there's no liquidation, no margin call, and Bitmex is just trying to get you to buy these, it's because the market makers make a killing off short selling these at high prices. They can just short sell an upside contract, they can just short sell a downside contract, and if price stays within that range, they make money from both contracts. Even if price went beyond one, they would still be okay, because the other contract that they short sold would have enough profit in it anyway that they probably wouldn't even lose that much, or if any. So if you're listening and you're a Bitmex designated market maker, good for you. You can be like, oh, I'm just going to keep making killings off retail traders who are trying to buy these contracts. If you're a retail trader, yeah, only like 2 scenarios I'd ever advise anyone to even touch these. If you expect a crazy amount of market volatility and you don't want to be liquidated and you don't want to have a stop loss, then I guess, I mean, you could try to buy one of these. Or if you want to hedge against insane volatility, so let's say we go long on the perpetual swap, and to protect ourselves against a massive down move, we buy 1 downside or 10 downside of these contracts, 10 downside contracts. So if the price did crash, we would still make some money because we'd be hedged. But if price went up and your perpetual swap long actually made money, well, you wouldn't make as much money because your hedge would actually cut away from some of those profits. So that's maybe why someone would want to do it. And this is what it looks like for settlement history. And if you click on Bitmex and go to the settlement history page, every time it says 0, that means that the contracts expired worthless for anyone who had bought them, for the downside and for the upside. Statistics, 62.5% of the time, you would have been out of the money. You would have lost all of those contracts if you had bought a downside. Again, even in these 12 out of 32 times, the times where you would have been in the money, you probably, I mean, sometimes you wouldn't even have made any money because of the amount you'd have to pay for the contract, for the downside contract. So the actual profitability historically of these is probably like 20, 25%, just guessing. Like 20% maybe, 25%. So, that's not high. Even worse with the upside. These are out of the money 81%. These have been out of the money 81% of the time. So, yeah. And even if price clears above that, then you would really need to, price would really have to be way above that for you to make any money on this. And if you want to know that, take a look here where this number isn't 0, where people didn't lose all of their contracts. What this means is that you would have had to buy at an average entry price of below this number. You would have had to buy at an average entry price below 0.00115 for you to make any money at all. Downside, look at this number here. Strike price was at 37.50. Great. Price went down to 36.28. But guess what? If you had bought at any price above 0.00336, you would have lost money. If you had bought at any price below this settled price, then, hey, you made a little bit of money on these contracts. So basically, just zooming out, 72% of the time, XBT has traded between these strike prices. And we can use that to our advantage. We can look at the strike prices, and we can note that there's a higher probability that price is probably going to stay within that range. Now, let's go over some other strategies where we can, pardon me, use this data not to trade, but oh god, yeah, don't trade these, but actually to use the data for sentiment. Here we have XBT, and here we have this guy here. Whenever the downside contract gets very, very high, that shows us an excessive amount of pessimism, which means we might want to buy. So here, we had a lot of pessimism here. A lot of people were buying those downside contracts. Where do they buy them? Well, let's look at the first spike in buying. That was here, right before price went up here. Price did continue to go down, but you could see the price does go up after a lot of these guys buy the downside contracts, and even worse here. At this point in time, in my cursor, this is where a lot of people bought those downside contracts, and that was like right here before price went up. Looks to be about like 5%. So basically, each time we see just a massive spike in the downside, price tends to consolidate or go up. Massive spike in the downside here, price went up a bit. Yeah, massive spike in the downside contract here, price went up. You get the idea. Massive massive spike in the price of the downside contract, not down spike. That was here. I don't know if you guys can see that cursor move. That's right here. A lot of people have bought those downside contracts and price went up. So too bad for them. But we can use these for a gauge of pessimism and optimism in the market. Whenever this is very high, that shows us high pessimism. Let's look at optimism. So looking at the upside contracts, whenever people bought a lot of the upside, that was here. A lot of people bought the upsides here before prices kind of didn't really do anything. And also a lot of people bought the upside contracts. I think this one's kind of sad. A lot of people bought them, come on price, scroll, here, right at the very top. Yeah, we had a double top here, but yeah, a lot of people bought those upside contracts here, December 20th, and price just went down. So that's one thing you can look at, just, hey, is the upside contract getting very, very high relative to its historical values? Is the downside contract getting very, very high relative to its historical values? This can show us optimism in the market, or retail optimism, and the other one can show us retail pessimism. What we can also use is volume. If we've seen an insane amount of volume, that can show us that a lot of retail traders are probably buying these contracts. So if I was to go to here and look for a volume spike, you can see that we had a, is this the upside or the downside? I actually forgot. Pretty sure that's nope, didn't mean to do that one. I think this is the downside that we're looking at. Yeah, it is. Sweet. Just want to make, I want to make crystal clear. Okay, so here we can see a major volume spike in the downside. A lot of people had bought these, had bought the downside, and that was, I think, right before, yeah, right here, where price did go a little bit up. But again, just because there's a volume spike, that does mean a lot of people bought and sold, but it could mean that a lot of people had, if a lot of retail traders had bought at consistently higher prices, then that can show us that there's a high amount of demand for these downside contracts. So a lot of retail traders believe price is going to go down, but if a lot of them had actually just panicked and sold their contracts, then that can also show us something. So you wouldn't want to just look at volume for the upside and the downside contracts. You'd want to find out what was the futures price, not this futures price, but what was the weekly linear futures contract price doing when volume did this? Because that's very important to know. Did the futures contract rise or did it fall? If it rose, well, then that's showing us that here a lot of retail traders had probably bet on the market was going to go down. So the market just went sideways. Those contracts probably expired worthless, and they probably lost. And then just after those downside contracts expired, price went down. Just to be like, oh, you were right, but not within 7 days. Bye-bye. So, you know, then another volume spike. I thought I saw a really good one back here. Yeah. 22nd of June at 22nd of June at 4 a.m. Oh yeah, this one's 4 a.m. This one, yeah. So a lot of people may have sold off or bought their contracts, but here price did continue to go down. Bottom line, I don't want to get like too deep into this, maybe in a part 2, but basically you can use the volume for the upside and the downside contracts to look for what are the retail traders doing? Is there an insane amount of pessimism in here? Is there an insane amount of optimism in here? And you would just do that by looking at the price and the volume of these contracts. And you'd probably also want to look at the settlement price, at the strike price. And you can find this in the Bitmex site. If you click on the contract, it'll tell you what the strike price is for the next contract. All right, so that's going to cover one of the strategies. Another one is pretty popular. This is one that's definitely been covered before, so this is not new territory. But expiration of the weekly linear futures, expiration of the options on Bitmex, basically. They typically are going to lead to high volatility. Or a potential reversal. That's like the two theories, that high volatility or reversal. And the sinister reason why we actually expect high volatility after expiration is that the market might want to screw over the retail traders who had bought, let's say, a downside contract, like let's say somewhere around here. And then right after those contracts expire and the market makers make a killing, then price just goes high volatility downward. And they would have made money, but, expired. So, you know, that's why we might get some high volatility sometimes right after these expire. And you can see here, kind of looks like this one's a little bit weird. Not really much to say about that. Here it led to a reversal after high volatility, and then more high volatility. Here we just got high volatility right away, basically, and then a reversal. Here we just got high volatility very quickly. Higher volatility, it stopped the period of low volatility. Each of these vertical lines is the expiration time, the exact expiration time for the upside and the downside contracts, if that wasn't clear. Here we break the range finally and go down. So anyone who had bought a downside futures contract anywhere around here, oh, expires, now price goes down. And reverses too. This one's pretty sad. So if you, this is sad because between this time here, I'm trying to point to it, but you guys can't see it. If you had bought an upside contract from anywhere from here to here, so let's say you bought an upside contract at a really good price, and you bought it when Bitcoin was trading around here, and your strike price was like here, your contract would have expired worthless. You would have lost, and then like a few hours after, price would have gone to a level where you would have been profitable. So I don't know if this is manipulation, but market makers are going to be making money. So, yep, led to a reversal and high volatility, led to a reversal and high volatility. Here, nothing really happened. Yeah, we got high volatility. We got like a high volatility here, high volatility here, high volatility kind of all over the place. And then here we'll see if we get some high volatility and a potential reversal of this move. All right, that was a lot to pack into like 20-something minutes. This is just a part one of looking at these upside and downside futures contracts. Just to summarize, so you guys can get a takeaway if you dozed off during part of it or did find it interesting or were like, how does this help me in any way? Basically, don't buy these upside and downside contracts. You're just feeding the market makers who can short at great prices. Don't try to play the order book on the upside and the downsides at futures contracts. I don't think that's going to go too well. Yeah, even trying to set a bid at a very good price, a buy order at a really good price to try to get that contract, I just don't think that's going to work that well. But what does work well is look at expiration times of these. You can also look at the amount of volume being transacted in the upside contracts. Look at the volume transacted in the downside contracts. Looked at how optimistic or how pessimistic the market has been overall by looking at how high the price of these contracts has been getting. That's one thing you can look at, if you are so inclined. And then finally, if nothing else, just the simplest thing is you can use it for range. So you can look at the strike price of a futures contract, of the weekly linear futures, and look at the strike price of the upside and the downside. We can expect the majority of the time the price is going to want to stay in between those lines. 72% of the time, historically, price has stayed between those two lines and moved on low volatility, even when retail traders have bet on high volatility. And because the only reason to buy an upside or downside is betting on high volatility in a direction. And buying both, like trying to buy a downside and an upside contract, if you think like you're being super sneaky with it, that's probably not going to work well. Yeah, that's probably not going to work well at all. You're probably just going to end up, price is just going to settle right in between the two strike prices, and you're going to lose both contracts. So avoid these contracts, I'd recommend, until maybe if the strike prices get better. Maybe instead of 95% and 105%, Bitmex does like 101%, 99%. And then actually playing these contracts would be a lot more interesting. But if you have to bet on a 5% up move and then price to go even higher than that, or a 5% down move and price to go even lower than that for you to cover your actually and get break even, okay. Rant is over on these. Plenty of interesting things we can do to play around with these. And with that, happy trading, and comment below any questions you have or anything on these contracts that I may have missed. I am absolutely all ears to hear more about these interesting ways of stealing a retail trader's money. So have a good day.